Topic introduces the essential features of fixed income securities and explains how these instruments function within global financial markets. Fixed income securities represent debt obligations in which investors lend capital to issuers in exchange for periodic interest payments and repayment of principal at maturity. The program distinguishes between loans, which are private and generally non-tradable agreements, and bonds, which are standardized and tradable debt instruments. Major issuers include sovereign governments, corporations, supranational organizations, quasi-government agencies, and special-purpose entities established for securitization purposes. Understanding issuer type is important because it directly influences credit quality, risk profile, and expected return. A key characteristic of fixed income securities is maturity, which refers to the date when the final payment of principal is due. The remaining life of a bond after issuance is called its tenor. Bonds with original maturities of 1 year or less are classified as money market securities, while those exceeding 1 year are capital market securities. Some bonds, known as perpetual bonds, have no stated maturity date and may continue indefinitely while paying coupons. Maturity significantly affects a bond's sensitivity to interest rate changes and overall risk profile. Longer maturities generally involve greater uncertainty and therefore require higher yields as compensation for increased exposure to inflation, credit, and interest rate risk. Another central feature of fixed income instruments is principal value, commonly called par value or face value. This represents the amount the issuer promises to repay investors, usually at maturity. Coupon rate and coupon frequency determine the periodic interest payments made to investors. Coupon rates are expressed as percentages of par value, and payments may occur annually, semi-annually, quarterly, or monthly. For example, a bond with a $1,000 face value and a 5% annual coupon paid semi-annually provides 2 payments of $25 each year. Some instruments, such as zero-coupon bonds, pay no periodic interest and instead compensate investors through appreciation from a discounted purchase price to par value at maturity. The program also explains different bond structures and specialized fixed income instruments. Floating rate notes, or FRNs, have coupon payments linked to a market reference rate plus a fixed spread. Inflation-linked bonds adjust either principal or coupon payments according to inflation indices to preserve investors' purchasing power. Deferred coupon bonds postpone coupon payments until a later date, making them attractive for issuers with delayed revenue generation. These varying structures allow issuers to tailor financing arrangements while giving investors exposure to different risk-return combinations. The diversity of fixed income products demonstrates how bond markets accommodate varying economic conditions, investor objectives, and funding requirements across global capital markets. Seniority and collateral provisions are critical considerations in assessing bond risk. Debt holders rank above equity investors in the issuer's capital structure, but bonds themselves can have different levels of priority. Senior debt has a higher claim on assets and cash flows than subordinated or junior debt in bankruptcy proceedings. Secured bonds are backed by specific collateral, while unsecured bonds rely solely on the issuer's general creditworthiness. Because subordinated and unsecured bonds carry greater risk of loss in default scenarios, they usually offer higher yields. Investors therefore analyze the issuer's capital structure carefully when evaluating recovery prospects and potential credit losses associated with a bond investment. Contingency provisions, often called embedded options, are another major feature of fixed income securities. These provisions grant rights to either issuers or investors if specified future events occur. Callable bonds allow issuers to redeem bonds before maturity, typically when interest rates decline and refinancing becomes advantageous. Putable bonds provide investors with the right to sell bonds back to issuers under specified conditions. Convertible bonds permit investors to exchange debt securities for equity shares. Embedded options influence bond valuation and yield because they alter expected cash flows and risk exposure. Callable bonds generally offer higher yields to compensate investors for reinvestment risk and the possibility of early redemption. The relationship between bond prices and yields is a foundational concept emphasized in the topic. Yield represents the return investors earn based on a bond's market price and expected cash flows. Fixed coupon bond prices and yields move inversely. When market interest rates rise, existing bond prices fall, and when interest rates decline, bond prices rise. Yield curves graphically display yields across different maturities and help analysts interpret economic expectations and market conditions. A normal upward sloping yield curve indicates higher yields for longer maturities due to greater uncertainty over time, while an inverted yield curve may signal expectations of economic slowdown or declining future interest rates. Finally, topic explains the importance of bond indentures and covenants in protecting investor interests. A bond indenture is a legal contract between the issuer and bondholders that outlines repayment terms, collateral arrangements, credit enhancements, and issuer obligations. Covenants included in indentures may be affirmative or negative. Affirmative covenants require issuers to take specific actions, such as maintaining adequate insurance or providing audited financial statements. Negative covenants restrict issuers from engaging in activities that could weaken creditor protection, such as issuing additional debt beyond specified limits. These provisions reduce agency conflicts and help safeguard bondholders against actions that may increase credit risk during the life of the bond.